Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. Now, investors probably breathed a sigh of relief after the Federal Reserve acted as expected in the wee hours of this morning Singapore time, keeping interest rates steady in the 4.25 to 4.5% range, where they have been since December. The result has been good. Stocks climbed and bond yields fell as Jerome Powell managed to calm tariff-obsessed investors, signaling that the Fed saw no need for drastic action in the face of Donald Trump's trade war. The jump in stocks was in fact the biggest for any Fed day since July. Now, can the feel-good factor translate to markets here in Asia? That's where I defer to the experts. And in the hot seat today is Daniel Tan, who is a portfolio manager at Grasshopper Asset Management. Good morning, Daniel.
Morning, Emaad.
Hope you managed to not be too inconvenienced by the heavy downpour this morning.
Not really. I'm working from home today.
All right, fair enough. Initial thoughts on the Fed's decision then? Were they in line with your expectations?
Yeah, so we're broadly in line with our expectations because we have already thought that there was a high degree of uncertainty from the Trump policy changes, which will keep Fed on the sideline. So Fed actually delivered what market believed. But what was dovish was the fact that they indicated that they will slow down the pace of reducing its balance sheet holdings. That means that there will be more money in the system because they will slow down balance sheet holdings. This is seen as dovish last night. So I think what the overall sense for the markets last night was Fed's going to adopt a wait-and-see approach as we think that the Fed thinks that, well, there's bigger economic growth outlook and high inflation. These two factors will cancel out each other. So that's the takeaway from last night.
Yeah, as you rightly pointed out, the Fed's decision to hold rates steady, coupled with projections of slower economic growth and higher inflation, has alleviated some investor concerns about aggressive monetary tightening. It's led to rallies in the major U.S. stock indexes, but Asian markets may experience similar positive movements as investors anticipate perhaps a more stable interest rate environment. So what do you see the impact being on Asian markets of this decision?
From the start of this year, we have clearly seen that Asian market is enjoying the move in the U.S. in a sense that you saw the sell-off in the U.S. It's a rotation of investors' money from the hot money last year in U.S. markets flowing to the Chinese equities market. So we have seen this move at the start of this year, and I think it's not something new because if we go back 6 months ago and also our past two meetings with Money FM, we mentioned that the Chinese equity rally is something that we are watching. So going back 6 months ago, Chinese authorities actually introduced a few measures which is broadly positive for the Chinese market. One of which was the 500 billion facilities to enable in-state investors to purchase stock. So this was one. I think going very recently, a few weeks ago, there was also another news that was positive for the Chinese equities market. It was the recent meeting with top business leaders, including Jack Ma. So this underscores President Xi Jinping's commitment to revitalize the private sector and rebuild market confidence in China. So I think, are we late in the Chinese equity rally? I think we are not too late. I think there's more room for Chinese to ease. And why would they want to do that? I think they are timing their easing measures both on the monetary front and the fiscal front with the trade rhetoric that is coming up from Trump's second-term administration.
Yeah, Daniel, let's talk about something that some strategists at Bank of America Securities have brought up, and that is this, that China's stock rally may face what they call a meaningful correction soon, given its similarities with the 2015 boom and bust cycle. Now, Bank of America's caution stands out in a wave of bullish bets that has swept across Chinese markets this year. What are your thoughts on that front?
It's not wrong. I have actually seen the past three cycles of equity rally. It's more of a FOMO, investors being late and jumping on the bandwagon. So I think we could see a meaningful correction of 10% from here, which is what we are likely to think we will want to look in for this Chinese rally, or by closing some of the Chinese Hong Kong shorts, it will be maybe 10% off from this level. So if you look at the Hong Kong HSCI, is now closer to 9,002. If you could see a 10% correction from here, is something that investors could be looking out for.
Jerome Powell was pretty measured in his assessment last night, or this morning I should say, of how the president's action, the US president, Donald Trump's actions might shape the economy. And he cited the potential for the impact of tariffs on inflation to be transitory, so not something that he's expected to continue in the longer term. What do you think that means for the equity outlook in Asia?
On this transitory comments, it was also seen as dovish last night. But going back to COVID, when US exited the global pandemic, Powell was also wrong on this. In fact, he mentioned that the inflation would be a transitory period, but it wasn't, and he was forced to actually hike rates. So I think, as Scott Besson has mentioned, he could be wrong because clearly the Trump administration thinks that tariffs is going to stay. So we are going to see inflation being sticky. Although there's stagflation in the US, you see slower growth in the US. I think inflation is going to be something that's sticking out. But again, Fed mentioned that they're looking at hard data and less concerned about soft data. So that means that they will not be so concerned about consumer sentiments, but more focus on what is actually coming out from U.S. economic data. I think what it means for Asia, as you can see, the views have changed from the last meeting. I was more bullish about local currency, but as of now, I think what it means for Asia investors is I'll be more bullish about hard currencies mandate in Asia. That means your dollar emerging market bonds in Asia would do better than local currency mandates, which is investing in equities and bonds. The other thing that I think would possibly happen is in Japan, this unwinding of the carry trade will continue to happen, and you will see yen continue to strengthen from here. And of course, JGB is moving out from a low interest rate environment. It will continue to be slowly inching higher. The onshore JPY use will continue to move higher from here.
Yeah, okay. You touched on emerging Asia, so let's talk a little bit more about that. From Trump's first term, ASEAN could continue to benefit from trade diversion from China. Do you see that trend sort of continuing now?
I think we have seen from that data previously from 2017 to 2020, the flow of trade diversion from China to Southeast Asia to ASEAN as a whole has been in an upward trend for the period where Trump was having the first term. So I think this will likely continue in the second term. And I think ASEAN has been singled out for harsher treatment. The market has been pricing harsher treatment for ASEAN. But actually, if you look at what Trump has mentioned, they did not actually single out ASEAN. So I think maybe markets have been wrongly pricing this risk to ASEAN as a whole. So on the whole, we think even with the trade diversion, ASEAN could continue to benefit. And that's because most of the ASEAN countries like Malaysia and Philippines, I'll just mention Malaysia and Philippines for this time around because they are clearly the ones that are not so affected by trade war. And particularly for Philippines, if you look at what is going on in the Philippines, inflation rate has dropped from 6% in 2023 to 3% this year. So that will leave a lot of room for fiscal and monetary cuts and more fiscal boost this year. As well as Malaysia, we saw unemployment rate peak at 5.3% and it has come down to a meaningful 3.2%. So these two countries were fairly more bullish versus the others. As you see in the last quarter, last 3 months, Thailand and Indonesia both down around 15%, and that's because mainly a reflection of the trade rhetorics. And you mentioned the second wave of trade flows from China to Southeast Asia.
Yeah, we need only wind back the clock a couple of days as we saw haven bets falling apart in Southeast Asia after the Indonesian sell-off on Tuesday. And as you rightly pointed out, Indonesia comes close to Thailand in posting the biggest loss this year among 92 major equity benchmarks that were tracked by Bloomberg. So they obviously were once touted as a haven for investors to navigate Trump's tariff wars. Do you think Southeast Asia still has its appeal as a region-wide stock route deepens?
So I agree with you that Indonesia is under pressure, and rightly so, because of a few things going on. They have been emphasizing on arresting this currency depreciation of the rupiah. And I think the same thing goes for the baht as well. Both central banks are caught in the middle of to ease further because they clearly have the room to ease. But if they were to ease further, it will also mean a weakness for the currency. So I think in countries like Indonesia and Thailand are caught in the middle of these two, and that's why you saw the meaningful correction of 15% for these two markets. But again, as mentioned clearly, that household consumption is very strong in most of the ASEAN countries, and I think this will benefit both Indonesia and Thailand. And any meaningful sell-off further from here, it will mean a great entry level for some of these Indonesia and Thailand. In fact, to India as well, there could be meaningful correction because the rupee is also under pressure from trade rhetorics.
All right, Daniel, thank you so much for your time and for your insights this morning. It's been a pleasure having you on the show.
Thank you, Emaad.
You're welcome. We were in conversation with Daniel Tan, Portfolio Manager for Grasshopper Asset Management. Stay with Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.